Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me as usual is Erik Clapsaddle, our Senior Fixed Income Portfolio Manager. Erik, it's been a couple months since you've been here. Lots of economic data to talk about. What are some of the things that are sticking out to you as the most important?
Sure. Well, the labor markets have really become the preeminent part of the U.S. economy. We've spent the past 2.5, 3 years talking about and focused on inflation, not just here, but also around the world, while at the same time, the labor markets have remained very, very tight. And we've started to see that change. The U.S. unemployment rate has moved from 3.4% to 4.1% over the past 14 months. You'll see in this first chart, the amount of job openings exceeding the number of total unemployed people in the U.S., and at the peak, that number was 6.2 million more job openings than unemployed people in the United States. But it has been reduced to about 1.5 million today. That surplus of job openings is still not normal, but it's normalizing quickly. Another smaller sample of the U.S. economy has been manufacturing payrolls. In the first 6 months of this year, manufacturing payrolls have declined by 10,000 cumulative jobs, while last year they increased by about 11,000 jobs. A few other smaller data points have been things like initial jobless claims and continuing claims slowly rising. The labor force participation rate, even though we're in a fairly strong economy, continuing to trend sideways. And lastly, the underemployment rate, which is U6 it's called, or it's an all-encompassing unemployment rate that includes things like part-time for economic reasons, marginally attached to the labor force, discouraged workers. That underemployment rate has gone from 6.5% 18 months ago to 7.4% today.
Softening clearly in the labor market. I still remember in my textbooks that 4.1% unemployment was still really good data, but softening. And it got Chairman Powell's eye, and he actually talked about it at the recent congressional hearings. So why don't you share a little bit now about how inflation is impacting consumers?
Sure. So obviously, to Paul's point, inflation has hurt consumers, but it's also really hurt small businesses as well. In some of the data points, though, we don't know the direct correlation, seem to be fairly correlated in things like credit card debt skyrocketing over the past 2.5, 3 years. The trajectory of it has been really unreal. And then on top of that, we've seen things like the U.S. savings rate really fall to low levels, which is one's savings of their disposable income. You're going to see in this next chart the Fed's favorite inflation gauge, and this is actually very good news, but it continues to drop closer to their long-term average goal. But again, we would be a little remiss to not mention the punishing outcome from the compounding of effects of inflation over the past 2.5, 3 years. Most recently, to Paul's earlier point, that Jerome Powell stated that they don't need inflation to fall back to 2% for them to start cutting rates. We're at 2.6% today, which leads to likely interest rate cuts this year. But with that being said, we don't see inflation falling significantly below 2%, if even to 2% by year end, which means the Federal Reserve's not going to have to make any drastic adjustments to their short-term interest rate.
Good comments on inflation, at least headed in the right direction. Another reason that the Federal Chairman Powell might be able to cut interest rates is some of the recent economic data that we've had.
Sure.
Can you share a little bit about what we're seeing there?
Yeah, absolutely. And though, again, focusing on like the overall economic data, it's absolutely slowing down. And it's not to say that the economy is not doing well. It's just part of every normal economic cycle that we start to experience a slowing economy after years, decade plus of growth. I mean, we have seen unbelievable stimulus both coming from the monetary policy side of things through zero interest rates, negative interest rates, $18 trillion of negative yielding bonds, government and I should say central bank balance sheets bloated with government bonds, mortgage-backed securities, corporate bonds, and fiscal stimulus that's really been unprecedented. I mean, they have lengthened out this economic cycle that really started post-Great Financial Recession through really early 2022 when central banks started to change their policies. But some of the positive things, since we focused on some of the slowing down things, really have been average hourly earnings on a 12-month basis have outpaced inflation for over a year now. The labor markets, to Paul's earlier point, remain strong. Certainly not as strong as they were, a year and a half ago. And the housing market continues to be stable, which, given the headwinds there, that's been a surprise for us. And in this last chart, you're going to see the real yield on bonds. Couldn't get through a market share without talking fixed income and interest rates. The real yield on bonds is the yield to maturity on a bond minus inflation, and that number has been positive for a while now. And that's a huge benefit to savers. The ability to grow assets faster than inflation and do it in a less risky way than being invested in equities is important for savers. We continue to see an investment in fixed income over the next 12 months as being very attractive.
And we have a lot of clients who already have fixed income portfolios, so they're thrilled that they're actually earning some interest on those investments. Erik, as always, thanks for your insights on the market. If you enjoyed today's market share, I encourage you to share that with friends, family, and colleagues. If you do not regularly receive the market share, I encourage you to subscribe using the QR code at the end of the video. And as always, thank you for the opportunity to serve you and your family, and have a great day.